Good afternoon. Welcome to our FBF online seminar. My name is Pierre Schlosser. I'm the scientific coordinator of the Florence School of Banking and Finance. And it is a real pleasure for me to welcome you all to today's online seminar on lessons for central banking from the euro area crisis. I'm very glad to welcome our lead speaker of today, Patrick Honohan from Trinity College Dublin and the Peterson Institute for International Economics. A warm welcome to you, Patrick. I'm equally happy to say hello to our two discussants of today, George Papaconstantinou from the EY School of Transnational Governance and Mariana Barata from the EY's Law Department. The topic of today is a very exciting one. I think that we have the occasion to discuss a very topical book by Patrick himself, and we just had a few minutes ago a very interesting seminar on financial stability in times of crisis, which I think concluding, it was a legal seminar, but concluded with the notion that there is not a clear and strict consensus among the legal community about the fact that there is a secondary objective for financial stability in the treaty. So I think that puts us on track for a very interesting discussion combining elements of macroeconomics, of course, politics, and law. I'd like also to thank my colleague Jan, who supported us in the preparation of the seminar. And before entering the fascinating discussion we have in front of you, I'd like to inform you about our school's upcoming activities in just a few minutes. As you will maybe know by now, some of our activities are on the training side, some are on the policy debate side. And I think that overall the school has a lot of resources for you that you may not even be aware of. So as a matter of fact, many of the e-books that the school has produced over the last years very well inform our discussion of today. We had different books on topics of governance, bearing the losses from the crisis. So it really links up very neatly the economic, legal, and political dimensions. You have in front of you the picture of the last ebook that we produced, and all of them are available on our website, so you can have a look and you can access them for free. On the policy debate side, another issue I wanted to flag to you is that on the 18th of November, we'll host an online seminar on bank business models, and on the 11th of December, we'll have an online seminar on liquidity stress testing with an expert from ESMA, and we will be glad to have you back also in those two occasions. Lastly, you will see on the slide who typically attends our training courses. There are central banks from across the world, but not only. There are also national regulatory authorities, European agencies, European institutions, and we're really glad to combine this diversity in what we do. Let me also glad you, in case you missed it, about the upcoming courses that we're going to have at the school. In February, we'll have a course on bank recovery and bank resolution. I think bank resolution will probably be touched on in this seminar of today. We'll have afterwards also a course on anti-money laundering, which we see as a key issue to be addressed, and where capacity building needs to be occurring over the next months and years. We'll have also a course on liquidity regulation, that's in March. And then later in the spring, we'll have a much awaited course on RTSE and safe assets, which I'm sure many of you will be interested in, and we'll open that registration for this course in the next 2 weeks. But then there's a myriad of other courses later in the year that should be of interest to you. We'll have courses on panel data, on monetary policy transmission, which again we'll talk about, I'm sure, in the next minutes. And also a course on sovereign debt restructuring, a course on MiFID II, and many others will follow after that. So you can find more details on our activities on our website. Let me also seize the occasion to briefly mention that the EY School of Transnational Governance will be launching a brand new 2-year master's degree as of September 2020. You can go on the EY's website also there for further information. And perhaps George in the Q&A, at the end of your Q&A, might also tell us a bit more about this. So, time to present you to one another. You're around 60 participants connected today. following us from almost everywhere in Europe and from several other continents. We have 41 nationalities represented. We're very glad to count on several participants from central banks and authorities. In terms of gender balance, we have 41% of women with us today, and almost 60% are men. On average, you have close to 9 years of professional experience. And as usually in our online seminars, we have a good half of the participants who are trained economists. Then we have 22% of lawyers, 16% have a background in business. And lastly, 73% of you have a master's degree, while 22% have a PhD and 5% have a bachelor's degree. So I will not give you additional details on who you are. I think you will have a chance to say a few words at the Q&A phase, and I warmly encourage you to do this. But in the meantime, how will our seminar be structured? Well, we'll ask Patrick to present his book in 20-25 minutes, which I know is really much of a challenge. But I know that Patrick will cherry pick a few issues to focus on. And then following Patrick's presentation, George and Maria will share their views with us. And after that, we'll open up the Q&A session I was referring to, where you participants will have a chance to write your questions or comments in the box that will appear on your screen. It's not on your screen yet. It will appear at the right moment. So let me stop here, disappear. I see that Patrick has been activating his to activate his microphone.
Now you can hear me.
Here we go. We have video and voice and everything. The floor is yours, and thanks to all the participants for the patience.
I will go straight into it. I want to talk to you about lessons for central banks, and particularly European Central Bank and national central banks in the euro area, coming out of the crisis. And that's a big topic. I have a lot of things to say about it, but I'm going to be selective. And the first thing I'm going to say is that there are three parts of what I want to tell you this morning, wherever you are. I'm going to talk a little bit about the role of the ECB in managing the euro area crisis. I'm going to then move on to say a little bit about what the Irish case tells us about crisis management by central banks in general. And with a few minutes at the end, I'm going to say a little bit about what the whole crisis tells us about how the modern central bank needs to behave, moving from something that was very aloof in the past to something that's much more intrusive. So, talking about the role of the ECB in managing the euro area crisis, were there missed opportunities? And I'm going to suggest that there were. And I'm going to philosophical concept of Buridan's donkey. Buridan's donkey was a donkey that was terribly thirsty. He was in the desert, I think. He was terribly thirsty and terribly hungry, and he could see some grain over to the left-hand side and some water on the right-hand side, but he couldn't make up his mind whether he was thirstier or hungrier. So he stayed in the middle between the two sources of nourishment, and he couldn't decide the way to go. In the end, he died of hunger and thirst. And I'm going to suggest that in a way, the euro area authorities, the ECB, and also the rest of the euro area authorities, in a way got caught in indecision between two possible courses of action and followed a middle course which was neither one thing nor the other. And then I'm going to mention something called the separation principle, which is very specific about central banking and very specific about monetary policy. It was a principle that was adopted by the ECB early on in the crisis and maintained for first 3 years or so of the crisis. And I'm going to say that it was a flawed analytical tool which actually inhibited the ECB from adopting policies that could have potentially been effective in dampening down the issues. So, well, why was the euro area crisis so severe? Some people think it was just bad luck. I like to throw up this slide. I don't really think this slide gives the answer, but it's really a little bit provocative. It shows you all of the European countries, including those in the euro area, not in the euro area, not even in the European Union. And it shows you the employment percentage change from peak to trough in the crisis. and then to peak to the 2017 when effectively the crisis was over. And what I like to say about this chart is that you see, if you run along the top, you see, yes, for sure, Greece, a euro area country, was the worst affected in the crisis. But then of the next countries, Latvia wasn't in the euro area when the crisis began. Neither was Lithuania, which is number 4. Neither was Estonia, which is number 6. Croatia, 7. Bulgaria, 9, and so forth. So actually, the financial crisis affected a lot of European countries, not just in the euro area. We have to keep that in mind. But nevertheless, I think there were some specific things about the euro area. One of the things about the euro area which was distinctive, the argument is made that there were design flaws, and the argument is also made that there are policy errors. Very briefly, there were design flaws that are alleged there were design flaws that affected the system in the early days. Just show you that well-known chart. Interest rates too low, some countries. Design flows in the post-crisis phase, the absence of the possibility of devaluing. But actually, that particular design flaw is not a design flaw. That's not a bug. It's a feature brought in deliberately so that used devaluation in a way that created an inappropriate dynamic between fiscal policy, wage policy, and exchange rate policy. But more interesting are the policy errors. And clearly there were serious policy errors before the crisis. Complacent approach by governments and by everybody in approaching fiscal discipline, wage discipline, and so forth. But for today, I want to talk about the post-crisis policy errors, and particularly this issue of indecision between taking a very strict approach, that might have said, look, investors have invested in securities cannot be repaid, for example, Greek debt, and a lax approach which would say, well, we want to bail out everybody inside. I would argue that, and I argue in the book, that a systematic approach in either direction would have reduced the severity of the crisis enormously. In specifically temporizing with Greek debt by providing loan finance that transferred debt claims from the private sector to public ownership, thereby making subsequent restructurings of Greek debt extremely difficult, extremely politically problematic. You know, the end September 2008 decision neither to bail out nor to bail in bank debt is something which is an example of this indecision between tough approach and a lax approach. Why did the ECB not introduce quantitative easing when the Americans were introducing it? That would have been an example of a relaxed approach. Here's where the separation principle comes in. The ECB said, look, we have financial crisis, problem of financial instability, of bank failures on the one hand, but on the other hand, we have tools for controlling inflation. Our tool for controlling inflation since the outset of the euro area has been the interest rate. Let's separate our toolbox into two. Let's leave the interest rate as the tool for managing macroeconomic instability and inflation control. And let's confine the use of other instruments, non-standard ones, like providing unlimited liquidity very interest rates are there, at the interest rate are quoted, not auctioning liquidity, fixed amount of liquidity, but providing unlimited liquidity to the market. Let's use that kind of non-standard measure only to deal with financial instability issues. So when QE was being introduced in the United States, the ECB felt we are doing enough to protect financial stability with the non-standard measures we have already adopted. We don't need QE. We have protected the bank's liquidity situation adequately. We are doing enough. It led them to two mistakes. The first mistake was that mistake on QE. QE is a non-standard tool, therefore you should not use it, according to the separation principle, to restore macroeconomic stability. The macroeconomy was in free fall in 2008. Low interest rates were being directed to that. They did not use QE because QE was a non-standard tool by the separation principle. It was not to be used for macroeconomic. And the second mistake that this led to was the policy rate increases in 2011. You remember there were two increases in policy interest rate in early 2011, 25 basis points each. Why did they introduce a higher interest rate in the middle of the crisis? And the answer is it's the separation principle. Inflation was edging up. There had been a surge in energy prices, and inflation was projected to reach 3% and exceed 3% later in 2011. Indeed, it did exceed 3% in late 2011. And so if you said, well, our tool for inflation is the interest rate, it made some sense to use the interest rate increases to control the inflation. But actually, the interest rate increase worsened the financial instability and the concerns about the sustainability of public debt, private debt all over Europe. The two mistakes generated by separation. Let me move on to my topic. Lessons learned from the Irish part of the crisis. There's a question for your poll. You can answer the poll here. Thinking a little bit, I haven't given you enough time to think about these issues. Would a systematic approach to bail-in or a systematic approach to bail-out have been better than what was adopted? While you're thinking about that, I will move on to two things about the Irish case, the lessons that we can draw from crisis management. The big thing everybody knows about the Irish case is bank guarantee and the fact that the bank creditors were all bailed out. I'm going to talk a little bit about the comparison between Ireland and Iceland in that case. Because in Iceland, the bank creditors were not bailed out. In a role of course, Irish situation, central bank finance was available from the Euro system. That was not available in Iceland. There are other interesting differences between Ireland and Iceland, which I'm going to come to. I'm going to say something briefly about what makes for successful recovery. So, very briefly, we all know the Irish banking crisis. These are Dublin house prices. You can see them soaring up there into 2007. They were 400 times what they had been in 1995 in real terms. So, and were the banks sensible? No, they weren't sensible. The higher the prices got, more very high loan-to-value loans the banks made. You move from 2004, 2005, 2006, the number of 100% plus loan-to-value loans up to 40%. So, easy to criticize the banks. But I want to say a few things about what happened in this so-called bailout of the banks. It's not the case that the banking losses were all borne by the Irish government. The grey slice there in the pie chart shows you how much the government ended up paying, about 37 billion euros after recoveries, more. larger initial outlay, but after recovery. The shareholders of the Irish banks lost almost as much, 29 billion. The shareholders of the foreign-owned banks, which actually they accounted for about a third of the retail banking market, and they lost 28 billion as well. And there was bail-in of subordinated debt holders, about 14. So there are quite a lot of other bearers of the losses. So it's possible to exaggerate the degree to which the losses all fell on the Irish government. What about Iceland? Well, there it's not possible to exaggerate what they did. The government managed to end up without any net cost of bailout. Initially, they had to make an outlay because they did cover the depositors in the Icelandic banks, but in the end, they recovered enough. Now, this is quite important because here that there was an enormous amount of austerity in Ireland, but the banking bailout part only accounts for a limited part of that austerity. There's a chart that at the blue line shows you the cumulative amount saved, fiscal savings made from budgetary adjustments, austerity, if you like. And the red part is how much it costs to bail out the banks. Because the banks were fiscal amounts laid out. So the banks it's a one-off. The banks, once the banks were paid for, there were some recoveries, and it flattens out. Whereas the austerity adjustments were pretty much permanent, or permanent for the period right up to the present, in a certain amount, a couple of years, while the crisis was severe. So it's not true to say that the amounts paid to the bank creditors was the source of austerity. Yes, the banks were the source of austerity, but not bailout of the banks. Small part, relatively small part. But there's a more important difference between Iceland and Ireland. Iceland was not in a currency union to finance all of the outflows that were threatened from the banking crisis. They just didn't have the foreign exchange to do that. There would have been, and there was in part, a collapse of the currency. But in Ireland, there was a huge recourse to ECB. You can see there was surges to 120 billion and then up to 180 billion. And this is at a time when GDP in Ireland was running at around 150, 160 billion. So huge central bank financing. So that was a huge difference between Iceland and Ireland. But it had a more important difference in the way in which adjustments subsequently occurred. That's where this shows you real wages in Ireland and Iceland from 2000 to 2014. Before the crisis, both countries are doing, look as if they're doing fantastically well. Real wages are rising at a rapid clip in both countries. The red country is Iceland, the green country is Ireland. Right up until 2007, they're more or less running in line. And then the crisis comes. Look what happens, a dramatic difference in the way in which the two economies adjust. Because Ireland is in the currency union, there is no devaluation of the currency. And indeed, there are some falls in prices. Because there are falls in prices and not so much falls in wages, there are some falls in wages. But the real wages actually rise in 2008, 2009. So right into the crisis, instead of an adjustment, a lowering of real wages, you have an increase in real wages in Ireland. What does that mean? It means that people who have jobs, who keep jobs, are doing okay through the crisis, but it leads to a massive increase in unemployment in Ireland and emigration. Whereas in Iceland, because the currency collapses, real wages also collapse, and that helps secure and protect some of the jobs in Iceland. So there's not so much of a surge in unemployment in Iceland. So there's quite a different distribution of impact of the crisis and of the adjustment in the two countries. That's a consequence of being in the currency union or not being in the currency union. I promised you that I would say a little bit about politicians and I didn't say that the politicians was going to be about politicians. Why Ireland managed to stick to the programme of austerity, and the recovery was a little bit faster than it might have been in a couple of other countries, and certainly this is where you move away from economics and you move into sociology in a way. Ireland's performance isn't bad in terms of employment. There's a solid black line there, shows employment before the crisis soared up in Ireland, collapsed then during the crisis, but then you can see this fairly strong recovery. So why the strong recovery? And I think we can point to three things about politicians and one thing about the Irish public. Politicians who are in charge, senior ministers, a group of 4 ministers running in a small inner cabinet, they were all older guys. And they're all now out of office, tired. They knew they were going to be out of office. They weren't saying, how am I going to win the next election? They were saying themselves, how am I going to live with myself in years to come, in my years of retirement? What are the history books going to say about it? They also were old enough to remember the previous crisis of the 1980s. It's actually quite surprising that there was a deep fiscal crisis in the 1980s, and some of the mistakes that were made in the 2000s mirrored mistakes that were made in the 1980s. But those politicians had been there at the time, and they remembered what worked in terms of correcting the crisis. And they realized that you had to move fast, decisively, and stay the pace. So there was an advantage. The generational progression to the younger generation happened after the crisis was fixed. I think that made things a little bit easier. It meant that people driving policy were people who were looking for the long haul. But they had to speak to a public that needed to be informed and satisfied that the direction was correct. And I think that's not just because the Irish public also remember the 1980s, and all remember the 1980s. I think the key here is that Ireland is one of the most globalized economies on earth. I'll give you one statistic. If you take the number of Irish-born people who live outside Ireland, and you express it as a percentage of the number of Irish-born people who live in Ireland, the percentage is 18%. And that's the highest percentage for any OECD country. Just an illustration of the degree to which Irish people know people who live abroad, friends, relatives. They've lived abroad themselves to come back. They're aware of the wider global economy. They may not like capitalism. They may not like the way the economy is treating them, but they know that if you don't play by the expectations of the markets, you're going to suffer more. And I think that general awareness that pulling up the socks was actually going to make things easier than not pulling up the socks. Pretty much almost completely out of time. But I want to say, oh yes, I won't go into detail on this. This chart is the other part of why the Irish recovery worked. And what it shows, I won't go into it. Look at it later. You can look at it later if you buy the book. You can look at it later on this as well. The forecasts that were made at the outset of the economic adjustment associated with the Troika, the macroeconomic forecasts, were bad. You look at some other countries, and we'll hear from George afterwards, Rihanna. In Greece, the forecasts for Greece, I would say in Greece, the forecasts for Greece by the Troika were terribly inaccurate. The situation in Greece deteriorated much worse than was forecast. Whereas in Ireland, the forecasts were quite good, and that really was the key to it. If macro forecasts had been too optimistic, I think it would have been difficult to sustain the political support for the adjustments that were being made. I don't know why the forecasts were good, but they were. There's a question. After all of that discussion of bailing out. Final point. Lessons for the modern central bank. And we have central banks behave in different, they put on different caps at different times. There's the classical central bank, which was dominant way back in the 1920s, but dominant also in the period, let's say 1990, 2005, 6. You have the classical central bank focused entirely on price stability. Even then, the classical central bank, even though it's focused on price stability, has had to do things with negative interest rates, QE, so on and so forth. So even the classical central bank is a different animal to what it was in the past. The second dimension to the central bank, which we need to bear in mind, and this is something that can be rather sensitive in the euro area, but I think we've got to face up to it squarely. The national central bank is the state's chief bank. It is a branch of a part of the state. It is a national central bank. It's something to do with the state. It's not to do with the government. It's not to do with the euro, not solely to do with the euro area itself. So far as price stability is concerned and the tasks of the euro system, yes, it's part of that, but it's also the state's chief. And that leads to certain decisions and stances that have to be taken by the national central bank. The third type of behavior from the central bank, which I think is becoming increasingly important, especially as more and more central banks, including ECB, have got responsibilities for bank regulation, and indeed in the case of the Irish Central Bank, regulation of insurance companies. A range of different types of firm. It needs to be more assertive. It's not good enough to box check. You have to dig into systemically important institutions in particular and address weaknesses in their conduct, weaknesses in their management, and so forth. We've seen that. We've seen central banks all around, not least the Central Bank of Ireland, being much more aggressive in its behaviour vis-à-vis financial institutions. And finally, a new dimension, I think, which is going to become increasingly challenges and decisions to be made about how far the central bank should go down a route of greater expansiveness, if you like, and looking around for tasks that it needs to do, even though they're not so explicitly in its mandate. And I think we need to be careful here. There are lots of suggestions and ideas, like ceilings on interest rates, sound like good ideas. Role of the central bank in helicopter money, for example. Climate change, I think there are definitely things that can be done there. So because central banks have been called on to do more and more things following the crisis, there is a risk that they will be dragged into areas that don't suit them, that they are not effective in, but there are also dangers in being too cautious in facing up to responsibilities that, because of their powers and because of their wider responsibilities, they ought to be doing something. Now I'm going to hand over to George, who's going to take these arguments apart and disagree with them entirely, I hope.
George, if you could connect exactly here, the floor is yours.
Thank you very much. And first of all, let me say it's a real pleasure to be asked to comment on the book by Patrick. And Patrick and I were both present in the early days of the crisis, representing from different roles, him as a central bank governor, me as a finance minister, the two countries that were in the center of the storm. So what I would like to do is, first of all, say a few things about the book itself, because Patrick didn't really talk about the book. He talked about some of the conclusions coming out of the book, and then zero in on a few issues which I think are important, but also hopefully will feed into the debate after the remarks. Okay, so this is a book which goes much beyond being a simple account of the period. It's a scholarly volume. It explores monetary policy, crisis, central banking's past and future. It's about Ireland, but it's about much more than Ireland. And therefore, there are multiple readings of the book, depending on what you are mostly interested in. My comments reflect my background as a participant in the crisis, so that's what I will be focusing on. It's also very nicely written. He starts by reminiscing how he loved as a child to hold the halfpenny piece depicting 6 pigs. So it's not a dry central banking book. It is written very nicely. Let me first start with some of the conclusions that I completely share. Patrick is saying, for example, domestic macro management should have been better adapted to the exchange rate regime. Absolutely. Prudential policy should have been less passive. Yes. Banking losses in Ireland accelerate the need for the government to adjust its budget. In other words, banking losses were not in itself only the need, did not create the need for the budget, but they accelerated that need. The problems were there already. The Troika program did not cause Ireland's austerity, it eased it. This is something that reflects on a number of countries, mine included. The Irish crisis cannot be blamed on the membership in the euro area. And of course, EU management of the crisis was poor. Governments with sufficient headroom terminated counter-cyclical fiscal spending way too soon. And the ECB response failed at first to fully understand the severity of the unfolding crash. And it was wrong-headed of the ECB to prevent the bail-in in Ireland in the early stage. And I think it's very important that a former central bank governor actually comes out and says that. So the book has 4 parts, and there's a first part which Patrick calls currency. I will call it historical part. And what's interesting here is that, for example, he talks about the choice of how currency is made. And he's got a very insightful, drawing on Ireland, very insightful historical context into the debate fixed and flexible exchange rates. Then he talks about the road towards the euro. And of course, the key question there at the time was, and still is, would the risks of asymmetric shocks outweigh the benefits of reduced currency instability? And at the time, there was no clear answer. Therefore, the decision to join the euro was a political one. Then he moves on to the onset of the euro area crisis. He discusses sudden stops, design flaws in policy areas, debt restructuring, earlier bail-in, and the infamous rate increases in the middle of the crisis by the ECB. Then there's a second part, which he calls credit. I'll call it the analytical part. And he talks about safe and sound banking, a very nice phrase, the inherent fragility of banking. I would have liked there to hear more about the capture of the Basel II framework by banks, a big element in the crisis that came after. He goes on to talk about faults in financial services, discusses NPLs, compares Ireland with Iceland, makes a very interesting statement that Irish banks have not stood out as important contributors to Irish economic growth. And then he moves on to the role of central bank in this context with the different types of banks that he also discussed in his presentation. Classical, assertive, and expansive, and I'll come back to the expansive in the end of my brief presentation. The third part is the crisis part, the narrative part, so to speak, which to me is the most fascinating. He talks about the blanket guarantee. He's very critical of it. He calls it badly designed, doomed to fail. He goes over different alternatives and sort of tends to be of the view that a limited guarantee would have been better. He talks about the race to stabilize the banks, for example, the National Asset Management Agency, and then the bailout. Of course, there the comparisons with Greece were very real to me. Ireland, being the second, helped very much, I think, in the negotiation. He has a really nice anecdote, which I hadn't seen before, about the very sort of senior commission officials coming in the middle of negotiations, sort of throwing in the 12.5% corporate tax rate as an issue that needs to be looked at, sort of completely irrelevant to the actual discussion, but sort of finding a good opportunity to bring that issue in there. And the dynamics of the different institutions, which very much resonate with my own experience, the IMF actually being the most lucid in this story and having a much more realistic, for example, view of the fiscal path, of the need of a bail-in, etc. And then it talks about the cleanup, where Ireland did it much better than the others. As a final taking stock a part, which is, I would say, reflective and prescriptive. He discusses the whole European decade of bank failure. He discusses the growth of financialization as a common thread in different countries, ELA, bailouts versus bail-in, the boom and bust story of the Irish economy, and the lessons earned. And what's interesting here is that this is a book which focuses specifically not just on Ireland, on monetary policy and banking in small open economies, which is something we don't have enough of in the literature. So, okay, that's the book in a nutshell. And in my last few minutes, let me just focus on 3 issues that come out and that also tie in with my own experience and concerns. The first one is the what if. The second one is Deauville. The third one is ECB in the future. Let me take each of the 3 in turn. The what if. Patrick talks a lot about the counterfactual, what would have happened if. My particular question of a counterfactual has to do with the timing of bailouts. Greece's bailout, the first bailout, was in May 2010. The Irish bailout was November, December 2010. Greece's crisis was fiscal. Ireland's crisis had its roots in the banking crisis, which then mutated, of course, to the fiscal accounts. We all know that the Eurozone crisis narrative is a fiscal narrative. It's a narrative of fiscal profligacy, which has driven excessive austerity in a number of countries. So my question here is, what would have happened if Ireland had fallen first? What would have happened if the Irish bailout, with its clear banking characteristics, would have come before Greece, which had fiscal characteristics? Would this have changed the narrative of the crisis? Would this have brought forward earlier the moves towards banking union? Second issue, Deauville, the famous Deauville decision between Chancellor Merkel and President Sarkozy in October 2010. The surprisingly short treatment in the text here. This is, to remind everyone, it's a decision that the bail-in of private creditors should be a prerequisite to EU support operations. It immediately drove spreads up in Greece and soon in other countries as well. I would like to hear a little bit more from Patrick. To me, this was a defining moment in the crisis, which made it fully systemic and therefore drove a lot of what happened afterwards. For us, it was very clear. But even though you can't claim that this is what caused the Irish bailout by any means, it certainly seemed to have brought it forward and made it inevitable. And third, final point is the ECB transformation and the future. Patrick talked a lot about this in his talk. We've gone from giving liquidity to banks to bond purchase in the secondary market to QE, and we've had a shift in the appreciation of what central banks do during the crisis. And there's a very nice phrase in his book, the effective central bank is increasingly an active and intrusive body. The central bank is an arm of the state, albeit not of the government. So this, we talk a lot about expansive banking. Climate change, inequality issues have been brought up. And here, to play the devil's advocate, the criticism of the more traditionalists who say that, hold on a second, we're now beyond the original mandate of the ECB, may have some ground. And there's a question here, do we continue this drift, which I think is a good drift, it's a necessary drift, or do we at some point put squarely in the middle of the discussion a need to revisit the ECB mandate, which is politically, of course, extremely difficult, given the positions of different countries. And I will stop here.
Thanks a lot, George. So in the interest of time, I would just suggest that we move on to Maria immediately.
Thank you very much, Pierre, as well for this opportunity to share my thoughts about the lessons learned in the crisis. And hello, everyone from Florence. I would like to start by referring that I really enjoyed reading Patrick's book. I fully agree with George that it's not a book about Ireland, but much more than Ireland. And as an experienced academic, but also central banker, Patrick included very stimulating insights in the book, which should be carefully analyzed understood by all researchers and supervisors working in the broad field of the banking crisis. I was particularly found by the several questions that Patrick included in the book, and some of which I will actually refer in my presentation today. So for my 10 minutes time slot, I prepared a brief presentation that where I will try to cover very briefly the three topics that Patrick included in the book: currency, credit, and crisis. However, and since I'm a lawyer and not an economist, I will draw your attention to some of the legal aspects of these three topics. And finally, and as a third example of a country who was severely affected by the euro area crisis, I'll spend some time focusing on the Portuguese case. So, in the first three chapters of Patrick's book, he looked at currency choices of member states, at decisions to create and to join the euro, and finally at the euro area crisis. I'll speak about this last topic. And going back to the question that Patrick posed today, why was the euro area so severe? One of the reasons that the book puts forward is the existence of systemic design flaws, meaning that even if the shock was too large to be absorbed by an individual country, in theory it could have been absorbed by the euro area as a whole, if the treaties did not include a no bailout clause. This no bailout clause is included in Article 125, paragraph 1 of the Treaty on the Functioning of the European Union, and it includes the prohibition of on the financing of governments by the central banks. The inclusion of such clause was driven by the desire to prevent moral hazard among member states, by believing that each country in a way should take care of the failure of its own banks. And if this clause had not existed, arguably Europe as a whole could have financed the shocks in a different manner, which might have resulted in less unemployment and loss of output throughout the euro. But in the end, a considerable amount of financing was provided, namely when the ECB introduced the security market program and started buying the bonds of Greece, Ireland, and Portugal in the secondary market. However, in Patrick's words, it was too little and too late. The alternative to bailout the creditors with European public resources would have been to enforce creditor losses where bank insolvency or an unsustainable public debt had emerged, which can also be broadly defined as a bail-in. However, this option was also not free from criticisms, and as a way of example, we have the case of Cyprus, where bank restructuring was a fiasco, the resolution of the Portuguese bank in 2014, Banco Espírito Santo, which raised many controversies, also the Italian case, which has been very creative in order to protect bondholders between 2015 and 2017. And finally, there is also an intense ongoing litigation on the Spanish case of Banco Popular, which was resolved in 2017. Moving on to the second topic, I will focus now on one of the main roles of banks, credit provision. And maturity transformation is a key function of banking. And overall, by making loans and investments that are less liquid than its liabilities, the bank is providing a really valuable economic service. However, the excessive maturity transformation is undesirable from a financial perspective point of view, since it has potential not only to threaten the individual stability of banks, but also the stability of the entire system as a whole. Therefore, retaining the confidence of depositors on a continuous basis is an essential task for banks to continue their operation, which means that the management cannot slide into risky investments in banks. And to strengthen the deposits confidence, the EU has put into place deposit guarantee schemes, which reimburse a limited amount to compensate depositors whose bank has failed. The key legislative piece in this topic is the Deposit Guarantee Scheme Directive of 2014, 2014, which is an upgrade in the level of protection of the previous, of the first directive on the topic introduced in 1994. Ensuring that banks actually have enough capital is one of the most essential parts of bank supervision. And here I'll draw your attention for two key legislative pieces: CRD, the Capital Requirement Directive, and the CRR, the Capital Requirements Regulation. Both of them transpose into the EU the new Basel III global standards on bank capital. Finally, on the crisis topic, Patrick describes in detail that Ireland's experience with the financial assistance program under the Memorandum of Understanding that was signed in 2010 could be summarized as a need for decisiveness, determination, and homegrown detail. Determination, since official lenders and markets were convinced that the problems of financial imbalances were coming under control. Determination, because implementation was driven by the determination to deliver on what was actually imposed. And finally, homegrown, since in order to stick to what was promised, it had to be to a large extent home-based. Has the Troika program caused a loss of sovereignty? This is a recurrent question asked in the countries that were under Troika's conditions during the Euro crisis. And these member states signed a legal document, the Memorandum of Understanding, where they committed to implement reforms monitored by the IMF, the European Central Bank, and the European Commission. And claiming Troika program cost these member states a loss of sovereignty is greatly exaggerated. But in the same way Patrick mentioned in the Irish case, I would say overall the Euro crisis has left a legacy of debt. It disrupted public service and brought unemployment records to the picture. Now, zooming into the Portuguese case, very superficially, I'll try to touch upon four key topics. And the first one draws the attention to the fact that when Portugal was unable to face its debt commitments, it was forced in May 2011 as the third member state after Ireland and Greece to request financial assistance to the IMF, the European Commission, and the ECB, jointly named as Troika. From a legal perspective, this request entailed the signature of a Memorandum of Understanding by the Portuguese government at the time, and the legal and binding nature of this document was repeatedly challenged during the financial assistance program. The program lasted 3 years and included a strategy aimed at restoring the confidence of international markets and promoting competitiveness and sustainable economic growth. It was based on 3 pillars: fiscal consolidation, stability of the financial system, and structural adjustment of the Portuguese economy, with a particular focus on the labor market. Sovereign debt loan assistance came with the conditions that Portugal had to meet, which were often labeled as austerity measures. Those conditions prioritized capital, rapid fiscal consolidation, and structural reforms, leading to dramatic changes in the Portuguese labor market, in particular towards work and social rights. The literature suggests that the center-right government used the Euro crisis as a window of opportunity to implement a reform agenda that would otherwise have been implausible and impossible in the country. And the opposition by the Portuguese Constitutional Court was, from a legal perspective, the exception to this reform agenda. As a way of example, the Portuguese Constitutional Court declared unconstitutional some of the austerity measures implemented by the government and the Troika. The literature also shows that the financial assistance program worked. In 2017, Portugal left the EU's excessive deficit procedure, which the country had been in since 2009. The unemployment rate also fell from 12% in 2015 to 6.3% in 2009, and the government estimates that the public deficit for this year will be close to zero. So, pointed as a successful story, Portugal is often called the Troika's good good pupil since it obediently adopted all the prescribed austerity measures. Very quickly, I would like to recap the three main lessons from the euro crisis. On the first topic, bail-in or bail-out, flip-flopping over bail-in or bail-out certainly brought and prolonged the agony in the euro area. As Patrick wrote, it is harder to decide which decisive course of action would have given the best results. But I believe that decisiveness and consistency from the outset would have seen a quicker result and return to growth and would have prevented a generalized loss of confidence in the euro area. It is never easy to address an economic crisis, and in the case of the euro area, several factors have made it even more difficult. For instance, there is an imbalance at the heart of the European Monetary Union. On the one hand, the powers of the EU vary widely between monetary policy, where it has an exclusive competence for the euro area, and economic policy, where it merely has a coordinating competence and where policy decisions are made at the national level. This was one of the causes of the crisis, and it has also been pointed as one of the factors that made it difficult to address. And finally, the second point leads to the third lesson, that the completion of the European Monetary Union depends on more solidarity among member states. And to finish, and just before starting the Q&A, I would like to ask you if you think that the ECB did whatever it takes to save the euro area. Thank you very much.
Thank you very much, Maria. So what I suggest we do, and I see that we have already the Q&A box in front of you, in front of us. So George, if you could join us back on stage. I would give the floor back to Patrick for his reactions to what both George and Maria put forth. And in the meantime, I would also encourage our participants to formulate their questions or comments in the chat box. There's always a bit of inertia at the start, so it's better if we can already give them the chance to reflect and think about what they would like to ask. And then it's 2:06, so I would suggest that we stretch it to 2:15 if all our speakers are available for that. Can we say 2:15? Patrick, George, Maria? Okay, very good. So, Patrick, in, well, 3-4 minutes, it's a challenge, but if you could just engage with the views, please.
Yeah. Okay. Well, thanks for the discussion. Really interesting points raised by Mariana and George as well. Let me just pick out two of them to give time for the Q&A from the floor as well. What if Ireland's crisis had come first? Would the whole attitude of Europe have been different? That's a really, really interesting question. I haven't really thought about it in those terms. I've often thought about what if the Irish crisis had happened first and how would that have affected Ireland? But I never thought of it in terms of that it might have influenced the way policymakers in Europe thought about the crisis as a whole. One thing that I would say is that in addition to focus on fiscal matters, policymakers were very alarmed about spillovers from one banking system to another. The expression was used, Greece is Ireland's Bear Stearns. And if you remember what happened in 2008 in the US, Greece is Europe's Bear Stearns, Ireland is going to be Europe's Lehman's. With this concept that any kind of financial disturbance could spill over right across the system and create a crisis even deeper. So I think, yes, I think Ireland would have been blamed in a way that it wasn't blamed as much later on for triggering a euro area crisis in the same way as Greece tends to get blamed, whereas in fact, as we saw, the crisis was very wide and affected many countries. The question of the ECB, its mandate, and does it have a wide enough mandate? I think opening the mandate question is I don't think it's going to happen. But I think that the lesson I would take from what we've seen is that ECB's mandate is quite broad. The secondary mandate is quite broad, but it needs to manage that in a way that retains engagement with the rest of the political process. So if it wants to do something on climate change, for example. It needs to be sure that this is aligned with political preferences broadly in Europe. And that means it needs to have a dialogue with governments. Independent of government doesn't mean that you're hostile or that you don't interact at all with governments. On the contrary, for these broader secondary mandate issues, you need to be engaging with the political system generally, including governments and legislatures. So those are the 2 points I wanted to raise.
At this stage, we don't have any questions, so I think people are aware of our time constraints. But perhaps I can give you, another minute if you'd like to engage with another point raised by George and Maria, and then if there are no questions, I would give the floor back to George and Maria for some concluding remarks.
Yes, and I think that Brianna has raised this whole point about bail-in and bail-out and the way in which people flip-flop. On the one hand, they would like to see, in some cases, you say, oh, well, wouldn't it have been grand if the Greek fiscal situation had been completely bailed out by Europe? And I think that we hear a little bit about the need for a fiscal entity in the euro area dealing with problems that arise in one country or another. We hear that from Mario Draghi. Mightn't be the same as a bailout of Greek situation. On the other hand, we hear a lot of criticism of measures, and Mariana sort of hinting at criticism of the measures that were adopted in bank resolution since the BRRD came in, measures that seek to, the BRRD seeks to enforce a kind of bail-in rather than bail-out. And is this going to be sustainable?
Yeah, I think we all go back in the reflection led also by Padua Schioppa on the currency without the state. No, can that be sustainable? And in that case, can there be a sustainable currency without a strong fiscal authority? And in the workshop I was mentioning earlier, which was organized by Maria and a colleague, one of the reflections we had was about, is the ECB really very strong because of the powers it has accumulated, or is it so strong because there is no fiscal counterpart that can set also delineate the various powers of the monetary and the fiscal actors? But I see you're puzzled.
You've got to remember that this system, which was considered by some critics to be unsustainable, bound to collapse and so forth, it has suffered the biggest shock that you could possibly imagine right in the middle of the system, relating to international flows, relating to sustainability of the banking system. It survived that shock. It didn't do as well as it might have, and we've analyzed things that it could have done better. But even though it didn't stumble on the correct and ideal solutions for a long time, and there were political tensions, it did survive and is stronger now going forward and has tools that it didn't have before. So it's easy to say you shouldn't have a currency without a state, but even a currency without a state has survived a very rocky period.
Of course, there's absolutely no appetite to reopen the mandate, as there is no appetite to reopen the treaties. But we have a drift. Again, it's a drift which I welcome. But the actual pressure on the new ECB president, Christine Lagarde, to manage by sheer personality and political persuasion to sort of bring together two very different ideas of what the ECB should be like, while remaining within a mandate which is clearly been sort of left behind in the times, is going to be very tricky. So in the same sense that we tend to, there is a criticism out there that we have on a number of European issues sort of gone beyond what was sort of agreed in an unwritten contract.
Interesting. Thank you, George. And Maria, okay, I can give 1 minute to Patrick at the very end so that you have the last word, Patrick. So Maria, if you just want to conclude.
Sure. Perhaps I'll pick on the question about whether bail-in and resolution are going to be a sustainable solution. And I think one of the first conclusions after the first experiments of enforcing bail-in through the BRRD since 2014 has been that there's a pre-crisis legacy which is preventing the full application of the bail-in tools. In particular, it came to my mind the situation where Italian bondholders had to be protected because there was a mis-selling case going on, and retail investors therefore were deserved a particular situation and did not allow for a blunt and strict application of a bail-in tool. But I think the direction is set, and the future might allow that the enforcement of this tool will be more successful than it has been so far.
Thank you. Patrick, final words?
George mentioned the ECB was the most effective institution in the crisis, and that's because it was an institution, not an intergovernmental cooperative mechanism. And it's a pointer to the ability of Europe to create institutions like that, which would provide direct and quick action in a way that the intergovernmental process doesn't. So we need both the institutions and the intergovernmental process. Final point: independence of the central bank been always considered a huge thing that you must keep very independent. How do you protect the independence? You don't protect the independence by standing aloof and not talking to anybody. You protect the independence by communication, by making it clear to the general public what you're doing and why you're doing it. And if you can convince the general public, your independence will be secure.
Thank you. I think this was a first very good discussion also on what central banking is today and should be in the future. So I think we should probably go back to that later in the year, or most probably next year. I would like to thank all our speakers of today for their very insightful remarks and for the presentation of Patrick's book. Congratulations again.